Wow, a 100 basis point rate hike, the biggest increase since 1998, and a huge shock for most economists who've just been expecting 75 basis points. Now, we've already seen a huge slowdown in real estate activity, and this bigger than expected rate hike is definitely going to push a lower price floor for real estate. But we think that investor markets and the average end user market might still end up moving at a different pace. So in this video, let's take a closer look to see how these different behaviors and real estate markets in Toronto might be moving for the rest of the year. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss other videos like this made specifically for real estate investors in Toronto. You and I know that investors make decisions based on numbers and facts. And because we all expect interest rates to keep going up, we're seeing a lot more investors being more proactive these days using future expected interest rates to crunch their numbers. So even though we just saw a 100 basis point rate hike, which takes variable rates to around 4%, investors have actually been using much higher interest rates for their projections. There's actually 3 more rate hikes left for this year. Another big one in September, possibly 50 to 75 basis points, and then maybe 2 smaller ones at 25 basis points each in October and December. And so this might take us to a possible 5.25% by year end, which is starting to be the rate that more and more investors are using in their calculations. What this means is that even though future interest rate hikes haven't happened yet, their impact might already be getting priced in for investment properties. And so as more and more investors start to do this, we're likely going to see prices fall a lot more quickly in these markets throughout Q3 and possibly bottom out sooner than the general market. Now, I have to be clear that this won't happen everywhere. End users, especially new home buyers, usually buy based on what they can afford at the current moment, and unfortunately, they are more likely to stretch themselves too thin. End user homeowners are usually more reactive and pivot based on what they're currently faced with. And so there could be a bigger lag between when rate hikes happen and when real estate prices come down. During the last round of rate hikes, Toronto semis saw a much quicker recovery compared to 905 detached homes. Take a look at this. You can see that the 416 semi prices actually went up by the end of the rate hike cycle, whereas 905 detached homes stayed more or less at the same spot. So based on this, our theory does check out. There is a bigger investor pool in semis in Toronto and more end users in the suburbs. So if history repeats itself, then we might expect bigger price drops to be priced in earlier for investment property markets, whereas we might continue to see more downward pressure throughout the rate hike cycle throughout this year and into next year for the end user markets. Besides being proactive versus reactive, holding power is probably a bit different too. If you've watched my videos before, you've probably heard it already. Investors tend to have stronger holding power because rents are on the rise. They might have a bit more cash flow buffer to begin with, and now they're also future-proofing their positions. And then if we compare different locations, we also think Toronto homeowners might be able to wait things out a little bit better than the suburbs. Take a look at this. New listings have come up year over year in the GTA, whereas they have actually dropped in Toronto. And if you look at Toronto homes only, semis seem to have better holding power compared to detached homes. Honestly, it's very hard to tell from 1 month's data, but it is interesting that TREB also pointed out the same thing in their latest Market Watch summary, saying that listings will be an important indicator to watch out for the next few months, which might be an indication of how much strength that market has. Now, what else should we watch out for? Sales is another one, but this is very much a lagging indicator. But perhaps because it's lagging, once sales improve, it'll be pretty obvious that things are improving. But then if you also want a more complete picture, I always like to go back to my favorite indicator, which is the sales to new listings ratio, where you can really see the listings to sales dynamics a lot more clearly. And so if this ratio starts to improve again, then this would be another positive sign that we might be approaching the floor for that specific submarket. Now, the last thing we should keep in mind is to track any changes to interest rate expectations. We saw a massive 100 basis point rate hike, which was more than what was expected at 75 basis points. And now the Bank of Canada is saying that they're trying to front load these rate hikes to avoid higher rates in the future. So it's possible that 100 basis points is probably the biggest jump that we'll see. And if that works out, rate hikes will start to slow down. Now, if things go better than planned, then we might end up seeing real estate, especially the investor markets, start to recover possibly faster. Take a look at this. A house with 3 units with $2,500 plus $2,500 plus $1,600 in rents each month at our current future-proof variable rate of 5.25% means we'll have to buy at $1.27 million just to stay cash flow positive. But if we end up seeing variable rates reach only 5% instead of 5.25%, then that same house can sell for $1.31 million to be in the same cash flow position. In other words, we're looking for any downward adjustments to interest rate expectations nowadays for a turning point for investment properties in Toronto. Of course, we are in a very dynamic market and things are changing all the time. If we continue to get actual rate hikes higher than expectations, we're going to keep seeing a lower floor for real estate. And so we'll just have to keep monitoring all these changing factors more closely. Here on our team, we're a real estate sales brokerage that focuses on investing in Toronto. And so if you want to talk more about real estate investing, or if you want to learn how to get started with real estate investing in Toronto, just reach out. We'd be happy to take a look at your situation and then give you our best recommendations on how to get on the right track. Once you're ready to buy, our sales team will help you buy it, offer renovations guidance, help you with leasing or property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.